What's up, guys? Stas here. Welcome back to another video. So I want to break down 5 ridiculously beaten up stocks that I'm looking at right now in the stock market. We're going to go over the charts, what I'm looking to do with these stocks, why they're down in the first place, and we'll go over the indexes, which as of now, it's about 1:30, 1:45 p.m. When I'm making this video, we're slightly down across the board. So guys, jam-packed video. Hit that like button. Feel free to subscribe and check out my Patreon if you guys want to keep up with what I'm doing in my portfolio. No pressure, obviously, but check it out if you guys want to. Linked down below. And now let's dive into it. And right here, I have NVIDIA stock pulled up, which is not one of the 5 stocks in this video or for this video, but NVIDIA is up around 0.75% right now. We're heating up a little bit, heading into earnings after the bell today, which by the time you're watching this video, the earnings are out. You probably already saw my NVIDIA earnings video. So let me know in the comments how we're looking with NVIDIA. But yeah, it's up a little bit now, creeping up, heading into earnings, and we might as well now just dive into the 5 stocks for this video. I'm sure you guys are sick of hearing about NVIDIA, so let's go over to stock number 1, Eli Lilly and Co. Ticker symbol LLY, which on the day right now is down just over 1%, but from the recent, I think, all-time high, yeah, we hit 972. Well, not even the recent all-time high, although 972 is the all-time high from a year ago. I guess we're down 27% from that point. But just in the last, month, the stock is down $200 a share. We're down 22% since pretty much the last earnings report. And you may be asking yourself, why? Well, Eli Lilly lowered their profit outlook despite their strong sales, and this is putting pressure on the stock, right? And the overall healthcare sector has underperformed recently with concerns in general over drug pricing reforms and the high costs associated with drug development. But we can see again, it is completely tanking, and really they actually revised and they reduced their full year profit outlook, which is really just destroying the stock here in the short term. But I think the more it comes down here, the more value that's in this particular company. You know, they're crushing it with certain drugs they have, like Zepbound, a couple other ones, right? And I think those will continue to grow. But we're just seeing some weakness in the stock, which, by the way, a couple of years ago was a lot lower. So over the last couple of years, Eli Lilly's up massively. It's just here over the last year, couple of months, really. It's been struggling. So I'm not in this one yet. But if it does start coming back down to the high 600s, mid 600s, I might consider picking up some shares of LLY. Let's go on here to the next one, which is also obviously very beaten up, or it wouldn't be in this video. Deckers Outdoor Corporation. It is down massively. I mean, it's down 5% on the day today. It's down from the last time the company reported earnings a couple days ago. It's down 20% from that. And from highs, it is down from 230 to now 104. It is down over the last 6 months, roughly 5-6 months. It is down over 54%. So clearly, Deckers Outdoor is not doing well right now, and there's a couple of reasons why here. In May this year, when the company reported earnings, they chose not to provide forward guidance for fiscal 2026, citing macroeconomic uncertainty related to evolving global trade policies. And the company, of course, is in the crosshairs here with the trade war, the tariffs going on, right? The company has been impacted by escalating trade tensions, including imposed or proposed tariffs on imported goods. And Deckers specifically cited macroeconomic challenges related to tariffs as a reason for withholding their full year guidance. On top of that, we're noticing analysts downgrading the stock, expressing concerns that Hoka's growth momentum may be slowing, especially as competitors like Nike ramp up their distribution efforts. So we're noticing weakness in the short term here on Deckers, but I don't think it's going to last much longer. And I'm going to wait with all these stocks, quite frankly. I'm going to wait until the charts really confirm a breakout, a reversal, which we're not getting on Deckers yet. We're not getting on Eli Lilly yet, which we'll see when it comes. And when we do get that reversal, if we do get it, that's when I'm looking to strike on these oversold stocks. For now, I'm just watching them, but we do kind of notice Deckers is putting in a little bit of a bottom, arguably, here in the mid 90s. You know, we held $93, $95 back early April, and we didn't really see much of a dump during April at all, you know, after Liberation Day when the entire market dropped. Deckers didn't go much lower at all. In fact, throughout April, it crept up. So that's a pretty good sign that maybe the bottom is in, potentially. You know, a lot of the selling came before Liberation Day. So that's why I didn't go down during or after Liberation Day. So maybe we'll see. Maybe the bottom's in. I don't know. But Deckers, I'm watching it very closely at this point. And I'm also watching UnitedHealth Group, which is probably the most risky out of all these. But it's down big time. We're down like 55% from all-time highs, something crazy like that in a very short amount of time, mind you. So UnitedHealth Group at this point in time is struggling for a lot of reasons, right? They lowered their adjusted earnings forecast for the year recently, and really this is, particularly due to higher than expected medical costs, particularly in the Medicare Advantage segment. And the company, believe it or not hard to believe, quite frankly, they actually suspended their 2025 financial outlook entirely, citing continued cost pressures. And on top of that, guys, their CEO resigned this month for personal reasons, which is never a good sign, right? Never a good look. And it's just been bad news after bad news for this company. The earnings were terrible. They lowered their guidance. They dropped guidance completely for the year. Their CEO left. I mean, oh man, UNH is not good, not looking pretty right now. But eventually I think they're going to turn things around, right? It might take a bit longer, which is why I said this is most likely the riskiest stock on the list, but it is one of those companies that I don't think is going to go bankrupt or, go anywhere necessarily. We can see on the max chart, we've pulled down a lot, erasing years of gains, but it's not like a devastating drop or anything like that. We're still up in the grand scheme of things over the last 10, 15, 20 years on the stock. So maybe now's the golden opportunity. I'm not buying it quite yet. Like I said earlier in the video, I'm waiting until these stocks show reversals on the charts, which we're not getting on UNH either at this point. But we'll see how it goes. And if we do ultimately get that reversal, I might just buy this stock here. So next one on the list, and by the way, guys, make sure to join my free email stock newsletter if you haven't done so already. I send out my top stocks weekly for free. That's linked down below. And if you guys want to be a part of the Patreon portfolio, watch me build out this portfolio. I actually just posted another update today going over how the portfolio has performed over time. If you want to be a part of that, that is linked down below as well. So number 4, we have Apple, ticker symbol AAPL, which you guys know is oversold like crazy in the short term. Apple hit all-time highs back in January, I believe, or the end of December. During that time period, we hit 260, and it got all the way down to 168. It was down 35% at one point, and even now, we're down 23% from highs, even with this nice recovery rally off the lows, which, by the way, we're not breaking out by any means just because we had this recovery rally. It's actually still making lower highs, still technically in this downtrend. So it's obvious why Apple stock is down. It's because of China. It's because of tariffs. It's because a lot of their products are made in China, which, again, tariffs, right? The trade war, this is affecting Apple the most out of any company pretty much. So that's putting a lot of pressure on the stock. But the second they come to a deal, we get some sort of agreement between the U.S., China, this is going to settle down. It's already starting to settle down. Again, we're up $30 off the lows, but I'm telling you, and you guys, I mean, you can guess this yourselves. It doesn't take a rocket scientist to tell you this. When we get a deal, stocks that are obviously very exposed to tariffs, like Apple, they're going to rebound the most. Stocks like Apple, stocks like Deckers, once we start getting deals, agreements, these are going to rebound quite aggressively, and I think Apple is probably the safest stock on the list for the most surefire, guaranteed rebound, although nothing's guaranteed in the stock market. Obviously, guys, we don't know what's going to happen, but if I had to guess, a couple years from now, which stock out of these will rebound the most, it might be Apple. It very well might just be Apple, or it might be CRM, the last stock, which is Salesforce, which is down big time here from highs. Salesforce is down from 378 now to 274. It is down 27% in the last couple of months, 6 months roughly, big time. And we have earnings coming up, by the way, CRM. Looks like today, actually. Oh, my goodness. I didn't realize. I forgot they're today. So when you're watching this, earnings are probably out. Well, they're not probably out. They are out for CRM, and the stock's probably moving big time in either direction. So CRM is down a lot. I think it's down too much. And overall, it will rebound in due time. It's already starting to show a bit of a rebound here on the 3-year chart. You're noticing that on the max chart as well. Nice little rebound here, guys. So CRM, the big reason why they're going down, or the stock's going down, is because their revenue growth has decelerated, which, I mean, this is something that a lot of companies deal with, right? It is what it is. As companies mature, their revenue growth decelerates. That often gets price into the stock, which in this case we're seeing. But ultimately, man, they are still investing big time in the business. They've heavily invested in their AI-driven Agentforce platform, and the company has indicated that Agentforce will only have a modest revenue contribution in 2025, with more significant impacts expected in 2026, right? So maybe this is, the golden opportunity for CRM before we get a lot of more, returns, in other words, from their Agentforce platform next year. Maybe this dip here doesn't last that long. So what do you guys think? Let me know your thoughts in the comments. Hit that like button. Of course, do not forget to subscribe. Do your own research. I'm not a financial advisor. Join the Patreon if you guys want to for my portfolio updates. That is down below. And with that being said, cheers. I'll take a sip of this water with you guys. Stay hydrated, and I'll catch you all in the next video.